That was Michael Burry betting against the housing market in 2008, a decision that not only made him billions but cemented his status as a financial legend. But what about today? In 2025, the market is as uncertain as ever. Rising interest rates, inflation, and AI-driven disruption are creating opportunities and risks. In this video, I'll break down his strategies, connect them to current economic trends, and show you how you should invest smarter in 2025. Michael Burry is a legend whose strategies have repeatedly stood the test of time. You've probably heard of him as the man who predicted the 2008 housing market crash, a move that not only saved his portfolio, but also highlighted his ability to think against the grain. But what makes him even more intriguing is his knack for spotting hidden risks in times of market euphoria. Fast forward to today, Burry has shifted his focus to inflation, market overvaluations, and the risks of speculative bubbles. For instance, in 2023, he shocked the financial world by placing a massive $1.6 billion bet against the S&P 500 and NASDAQ 100 using put options. Why? Because he believes many of the companies propped up by pandemic-era hype and easy money are unsustainable in a high-interest rate environment. Here's why this matters. Burry's contrarian mindset isn't about fearing the worst, it's about staying prepared. He digs deep into research, finds undervalued opportunities, and hedges against risks. And guess what? These are steps you can take too. From spotting growth sectors to knowing when to hold cash, Burry's strategies offer practical ways to navigate 2025's uncertainties and turn challenges into opportunities. To confidently navigate 2025, you need a clear understanding of the economic landscape. Key factors shaping the market include stabilizing inflation, rising interest rates, and rapid technological advancements reshaping industries. The 10-year break-even inflation rate, a measure of market expectations for inflation, peaked in early 2022, but has since stabilized near 2.2%, according to the Federal Reserve Bank of St. Louis. While this marks a return to more sustainable levels compared to the 2021 to 2022 surge, inflation remains slightly above the Federal Reserve's target of 2%. This means that purchasing power is still under subtle pressure, pushing investors to focus on inflation-resistant assets. For example, commodities like gold, which rose by 9% in 2023, and companies with strong pricing power remain essential components of a resilient portfolio. Interest rates, on the other hand, continue to play a decisive role. The 10-year real interest rate has surged from near zero levels in 2020 to approximately 1.8% in 2025. This sharp rise reflects central banks' tightening policies to combat inflation. Elevated rates make borrowing costlier for corporations and individuals, creating headwinds for growth in heavily leveraged industries. However, for income-focused investors, this environment has turned bonds into an attractive option. With U.S. Treasury bonds offering yields of around 4.2%, they provide a relatively low-risk opportunity compared to volatile equities. At the same time, technology continues to redefine the global economy. The AI market, projected to add $15 trillion to the global economy by 2030, is driving growth in industries such as healthcare, logistics, and automation. Companies that effectively integrate AI into their operations are positioned for rapid gains. NVIDIA takes the lead as the most profitable company in 2024, shows the transformative power of AI-driven solutions, creating a model for future investment opportunities. Michael Burry's investment philosophy offers a clear roadmap for navigating the challenges of 2025. Known for spotting undervalued opportunities and managing risks, his approach focuses on value investing, identifying sectors with long-term potential, and staying disciplined. This mindset is especially relevant as we face stabilizing inflation, rising interest rates, and rapid technological advancements. Value investing is at the heart of Burry's strategy. His recent 2024 filings highlight this, with big moves like doubling his position in JD.com, now making up 24% of his portfolio, and boosting his stake in Alibaba by 29.03%. These companies dominate the Chinese tech sector, but remain undervalued compared to industry averages. classic examples of Burry's knack for finding hidden gems with strong fundamentals. In 2025, opportunities are opening up across various sectors, especially in real estate. With higher interest rates pushing down property values, value investors have a chance to find bargains. REITs with strong cash flow and high demand properties in urban or industrial areas stand out as particularly promising. As markets adjust to elevated borrowing costs, these assets are likely to bounce back, exactly the kind of dynamic Burry has capitalized on in the past. Burry's moves in other sectors highlight his forward-thinking strategy. For example, he boosted his holdings in Shift4 Payments by 50%, showing his confidence in its role in the ongoing digital transformation of financial services. He also increased his stake in Baidu by 66.67%, positioning himself to benefit from the growth of AI-driven services in China. These decisions reflect his focus on undervalued companies in industries poised for long-term growth, offering a clear playbook for navigating today's challenges. Burry is also adept at identifying sectors undergoing major changes, like energy. Renewable energy companies such as First Solar, which saw a 35.6% revenue boost in 2024, are thriving thanks to global green initiatives. At the same time, geopolitical shifts and underinvestment in fossil fuels have renewed interest in traditional oil and gas companies. Burry's likely approach? A balance mix, oil for short-term stability, and renewables for the long-term energy transition. This diversified strategy captures both immediate returns and future growth potential.
I believe that agricultural land, productive agricultural land with water on site, will be very valuable in the future, and I've put a good amount of money into that. So I'm investing in alternative investments as well as stocks.
But just buying the land, not some stock tied to land.
Well, I'm a value guy, so I want to buy the land. I want the raw land, and then that's the way to get it cheapest.
Inflation will continue to play a pivotal role in 2025 investment strategies. Although the Federal Reserve Bank of St. Louis reports a break-even inflation rate of 2.2%, its effects persist across industries. Burry has consistently advocated for inflation hedges, favoring gold, which rose 9% in 2023. Other assets like dividend-paying consumer staples such as Procter & Gamble and farmland, which has shown consistent appreciation, serve as reliable inflation-resistant options. These investments offer protection against purchasing power erosion while generating steady returns. Risk management is a central pillar of Burry's philosophy. He has frequently cautioned against speculative bubbles, advising investors to avoid assets inflated by unsustainable hype. In 2025, his emphasis on diversification remains crucial. A Burry-inspired portfolio allocates 40% to equities, 30% to bonds, 20% to commodities, and 10% to cash. Bonds, now offering competitive yields, are particularly attractive, with U.S. Treasury bonds yielding around 4.2%. These fixed-income instruments provide reliable returns, particularly in a high-interest rate environment, while reducing portfolio volatility. Thorough research underpins Burry's success. Evaluating metrics such as debt-to-equity ratios, earnings growth, and free cash flow is critical in identifying companies capable of weathering economic challenges. For example, businesses with debt-to-equity ratios above 2 are highly riskier in the current high-interest rate environment and pose significant risks. Conversely, companies with manageable debt and stable cash flows are better positioned to thrive and deliver consistent returns. For individual investors, following Burry's strategies starts with finding undervalued stocks. Look for companies with low price-to-earnings, PE, or price-to-book, PB ratios. For example, a stock with a PE of 12 compared to its sector average of 18 could be a good value. If picking individual stocks feels risky, consider ETFs like the Global X Robotics and Artificial Intelligence ETF or iShares Global Clean Energy ETF. These funds provide exposure to growing sectors like AI and clean energy, offering diversification and reducing the risks of investing in a single stock. Michael Burry's investing success stems not only from spotting opportunities, but also from skillfully sidestepping the pitfalls that trap many investors. One of his strongest warnings is to avoid being swept up by market hype. The cryptocurrency bubble and the speculative frenzy in meme stocks serve as stark reminders of how chasing trends often leads to devastating losses. Burry also emphasizes the danger of ignoring fundamentals. Companies with excessive debt and weak cash flow are especially vulnerable in 2025's high-interest rate environment. Additionally, emotional investing, whether driven by panic or euphoria, clouds judgment. Maintaining a disciplined, long-term perspective is critical. Burry's success is rooted in conviction and patience, even during periods of market pessimism. Whether holding undervalued stocks, hedging against inflation, or capitalizing on structural changes in key sectors, his approach emphasizes research, calculated risk-taking, and resilience. In 2025, these strategies are particularly relevant. The combination of moderating inflation, high interest rates, and technological evolution demands a precise and forward-looking investment approach. By leveraging value investing, focusing on transformative industries, and hedging against risks, investors can confidently navigate these challenges, taking inspiration from Burry's proven methods. Burry believes the Big Short 2.0 is right around the corner. Click the video on the screen to find out why.